Hey everyone, welcome back to Corporate Decoder, the place where we decode the complex language of business and finance. Today we are diving deep into Lithia Motors Incorporated's latest quarterly report, and let me tell you there are some seriously interesting numbers in here about where they are headed. Before we get into the nitty-gritty, if you love getting clear and actionable insights from these corporate filings, do yourself a favor and hit that subscribe button right now. Also, we have a fantastic community over on Discord where we break down these reports even further. The link is in the description below, so come join the conversation. Alright, let us talk about Lithia Motors, or LAD as you will see them referred to on the stock exchange. This is a huge player in the automotive retail world, and their recent report for the quarter ending the 30th of September 2025 gives us a window into their operations and financial health. First up, let us look at the big picture statement that shows us where the company stands financially. This is the consolidated balance sheet. Think of this like a snapshot of exactly what the company owns and what it owes at a specific point in time. Total assets for Lithia Motors stand at a massive $24.5 billion as of the 30th of September 2025. That is a significant amount of stuff and value attributed to them. Compared to the 31st of December 2024, their assets have grown quite a bit. Now, owning a lot of assets often comes with owing a lot of money. Total liabilities are sitting at $17.7 billion. That is a substantial chunk, and it is important to see how this compares to their assets. This is where we see the owner's share, or what is left over if the company were to sell everything it owns and pay off all its debts. Total equity is about $6.8 billion. This number shows the book value of the company belonging to shareholders. One of the most interesting items on the asset side is inventories listed at $5.9 billion. This mainly represents all the new and used cars they have sitting on their lots waiting to be sold. It is a huge number, and it is crucial for a car dealership to manage this efficiently. And of course, to have all those cars on the lot, they need to finance them. Looking at their liabilities, you see floor plan notes payable, which totals $1.9 billion, and another category of floor plan notes payable, non-trade, at $2.9 billion, for a combined total of nearly $4.8 billion. This is how they pay for those vehicles before they sell them. It is a critical part of their financing strategy. Now let us move on to how the company actually made its money or lost it over the last few months. This is the statement of operations. For the 3-month period ending the 30th of September 2025, total revenues reached $9.6 billion. For the 9-month period, that number jumps to an impressive $28.4 billion. That is a lot of car sales and service business. Looking at the breakdown, new vehicle retail sales brought in $4.6 billion for the quarter and $13.5 billion for the 9 months. So, selling new cars is still their bread and butter. Used vehicle retail sales are also a significant contributor, with $3 billion for the quarter and $9.1 billion for the 9 months. It is clear they are selling a lot of both new and used cars. The difference between what they sold the cars for and what they paid for them, minus the cost of sales, is gross profit. For the quarter, it was $1.4 billion, and for the 9 months, it was $4.3 billion. This is money before they pay for all their operating expenses like salaries and rent. Interestingly, the gross profit from new vehicle retail actually dipped by about 9.7% for the quarter compared to last year. Even though revenues were up, this might suggest that while they are selling more new cars, they are making less profit on each one, possibly due to increased competition or fewer manufacturer incentives. But it is not all about car sales. After sales, which includes repairs and maintenance, showed a solid increase in gross profit. For the quarter, it was up 8%, and for the 9 months, it was up over 10%. This is a high-margin business that helps smooth out the ups and downs of car sales. The report mentions that after-sales earnings are proving to be more resilient during economic downturns, which makes sense because people tend to fix their existing cars instead of buying new ones when money is tight. Finance and insurance, often called FATAMP. I also saw a healthy increase in gross profit, up 5% for the quarter and 5.2% for the 9 months. This revenue stream is really important because it often has very high profit margins. Now let us look at operating expenses, specifically selling, general, and administrative costs, or SJTAMP. This is the cost of running the business day to day. For the quarter, SJTAMP was $998 million, up 5.8% compared to last year. They are spending more on SGAMP, and when you compare it to their gross profit, it is about 68.1%. This is a bit higher than last year, meaning that a larger portion of their profit is being eaten up by operating costs. The report explains this increase is largely due to acquisition activity, which makes sense as they are growing and buying new dealerships. And what does all this mean for the bottom line? Net income attributable to Lithia Motors. Inc. for the quarter was $217.1 million, and for the 9 months, it was $682.7 million. Both show an increase compared to last year. So despite some margin pressure on new vehicles and higher operating costs, the overall business is doing well, largely thanks to increased sales volumes from acquisitions and strong performance in after-sales and finance. In their financing operations, we see a mention of provision expense, which is essentially an allowance for expected loan losses. For the 9 months, this was $72.5 million. While it is a big number, it is important to note that the report indicates over 99% of their auto loan portfolio is current or less than 60 days past due, which suggests they are managing their credit risk effectively. Finally, let us touch upon debt. As of the 30th of September 2025, their total debt, net of certain items, stands at a substantial $14.1 billion. This is a key figure indicating how much the company has borrowed to fund its operations and growth. While that sounds like a lot, it is crucial to remember that this is a capital-intensive industry, and they have significant assets to back it up. They have robust credit facilities in place with a substantial amount of available credit, which is a good sign for their ability to manage their finances. Looking at the big picture, Lithia Motors is a company that is aggressively pursuing growth through acquisitions while also focusing on improving its profitability in high margin areas like after-sales and finance. They are not afraid to take on debt to fuel this expansion, and they seem to be managing their existing loan portfolio quite well. The dip in new vehicle gross profit margins is something to watch, but the strength in other areas seems to be compensating for it. Their strategy appears to be working with revenue and net income growing year over year. Alright, that is our deep dive into Lithia Motors' latest financial report. What are your thoughts on their strategy and financial performance? Do you think their aggressive acquisition approach is the right move? Let us know in the comments below. If you found this analysis helpful, please give this video a like and subscribe to Corporate Decoder for more insights like this, and for even more in-depth discussions and behind-the-scenes content. Make sure to join our Discord community. The link is in the description. Thanks for watching, and until next time, keep decoding.